with the terms which are used in the financial budget or the finance budget of the government of India. So this session, friends, is with that objective. What we plan to cover in this session today, number one, we start with what is vote on account and why vote on account. And then we'll talk about what is fiscal policy. And after the fiscal policy, we will talk about objectives of fiscal policy. What are the four key components of fiscal policy? Tools for fiscal management available with the government, factors considered by the finance ministers as and when they do the preparation of finance budgets. Then a question which of course is very common in the minds of everyone: do the elections weigh on the budgets? In my view, if the government in place is focused on well-being of the people and growth of the country, then the budget will not really be focusing on the elections, because even if there are elections around, uh, a right government will still would focus as to what is right for the government. And therefore, as we have seen when Mrs. Sitaraman presented vote on account on 1st February, we all would remember that there was nothing that could be ascribed in the vote on accounts that could be said that it was keeping the election in mind. So this government, as we have seen, is not so much worried about the elections. This government is more focused on how to take the country forward and how to make the country a $5 trillion economy soon. And then, of course, $10 trillion and $25 trillion and so on and so forth. Then we would be discussing the broad contents of Government of India finance budget as to what this budget would comprise of. Thereafter, we will be discussing key terms used in the finance budget that all of us need to be aware of so as to be able to make sense out of the budget which is going to be presented tomorrow by Mrs. Nirmala Sitharaman. We will also understand, as part of the key terms used in the finance budget, sources of tax and non-tax revenue. So for the government, there are sources of revenue which are tax revenue, and there are also non-tax revenues. We will understand as to what these two categories of revenues are for the government. Thereafter, we will discuss types of expenditures which are incurred by the government, because ultimately budget is a mix of the revenue and the expenditure. So once we understand the revenues, we will also focus on the expenditure. Thereafter, our focus is going to be on the deficit, the types of deficits and their significance for the economy. And this is where, friends, I would like to mention that we really need to focus. Understanding about different kinds of deficits which are applicable in case of the finance budget will really give you headway in heads up in being able to interpret and make sense out of the finance budget. We will also understand as to what is the significance of fiscal deficit for the GDP of a nation. We all know for ages we have been having a fiscal deficit year after year. Now, how this fiscal deficit impacts the GDP of a country, that is what we will understand. Then we will also talk about what is wrong with the revenue deficit, high or low. So, you have three types of deficits. You got a fiscal deficit, you got a revenue deficit, and you got a primary deficit. So, number one, we will understand as to how these three differentiate. And number two, we will also understand कि अगर किसी कंपनी के बजट में रेवेन्यू डेफिसिट है और अगर वो रेवेन्यू डेफिसिट ज्यादा है तो उसके क्या कॉन्सिक्वेंसेस हैं फॉर द इकोनॉमी, और अगर वो रेवेन्यू डेफिसिट कम है तो उसके क्या कॉन्सिक्वेंसेस हैं, और अगर वो रेवेन्यू डेफिसिट होने के बजाय अगर वो सरप्लस है तो उसके क्या कॉन्सिक्वेंसेस हैं फॉर एन इकोनॉमी, एंड ऑल्सो व्हाट डज इट टेल अबाउट द स्ट्रेंथ और वीकनेसेस ऑफ दैट पर्टिकुलर इकोनॉमी. Thereafter, our focus is going to be on, I'm sure all of you must have seen and must have read many times in the past that all the global players are always interested in seeing as to how is the primary deficit of a country behaving. So, and we will understand as to why is that global players are interested in the primary deficit of a country. Now, how do they interpret it? And what does it convey to them? And finally, last but not the least, we will also understand fundamental principles of good budget management. We all are understand it very well. Merely presentation of a budget is not important. What is also equally important is as to how the budget is managed by the Ministry of Finance and by the Reserve Bank of India and by the overall government of the country. And that is what we will understand. So let's move forward. So the first topic, the first item that we have on our agenda is why note on account and why vote on account and why vote on account. So because we all remember on 1st July, on 1st February 24, Mrs. Sitharaman presented not the full budget, but vote on account. So the question is, why did she have to present vote on account? Why she could not present a full-fledged budget? And the reason is, friends, number one, during election years on the budget day, regular budget are not presented. What is presented is simply a vote on account. And why a full-fledged budget is not presented and why only a vote on account is presented. And that is because presumption is that the same government may not be there in power after the election. So it is possible that there may be another government or another party which will come to power. And therefore, the presumption is a full-fledged budget should be presented by a government which is also going to be responsible for its execution. And therefore, during the election years, whenever there is a budget, it is always it's not a regular budget, it is a vote on account. And what this vote on account is, this vote on account is nothing but enabling approval to the government in power for running the administration until the new government is formed. So the vote on account is for a limited purpose, and that is to enable the government in power on the day to be able to run the administration until the time the next government is formed. Now, friends, in my view, and I'm sure in the views of many people in this country, ideally the election should be held in the month of November or December and not in the month of May and June, April, May and June, as has happened this time. And why is that? So that is because April, May and June are the months of very hot summer. And therefore, a lot of people, even though they wish to go and vote, they stay home, do not go for voting because they're scared of the heat outside. So if the budget, if the elections are held in this country in the month of November or December, that is going to be the month where it's not going to be hot, rather it's going to be a cold weather. And I'm sure in a cold weather, people will not mind coming out of their houses and go for voting. So this will definitely improve the voting percentage in this country, which is so much necessary for the democracy in this country to really mature, The additional benefit of having the elections in the month of November or December would be that because since the elections are held in the month of November or December, maybe the budget can be presented in the month of January, or it can be presented on 1st February as it stands today. And that's where there would not be any need for a vote on account to be presented, because if the elections are held in the month of November or December, then the government will come in the power in the month of January, and they would be able to present the regular budget on 1st February and be also responsible for its execution. There has been a lot of talks in this country about one nation, one election, which again is an imperative need in this country, for many reasons, and I'm sure whenever this reforms is implemented, our legislative will take care that the election dates are also around the month of November or December, so that it serves the twin purpose. Now, let's come to the next topic, and that is, what is a fiscal policy? What is a fiscal policy? So, at the outset, friends, let me tell you, for simplicity, the term fiscal can also be read as financial. तो जो fiscal का मतलब है, वही financial का मतलब है, और जो financial का मतलब है, वही fiscal का मतलब है. The only difference is when we talk in the context of the government or the economy, we use the term fiscal, and when we talk in the context of the corporate world, then we use the term financial. But remember, both of them mean the same thing. For a government is going to be fiscal policy, for a corporate is going to be financial policy. So for simple understanding, you can always remember, whenever somebody is talking about the fiscal policy, fiscal discipline, remember they're talking financial discipline for the government as a whole. Now, what is a fiscal policy? The financial policies of the government are collectively referred to as fiscal policy. The finance budget of Government of India, the RBI's credit policy and monetary policies are integral part of the fiscal management by the government of the country. Meaning what? Meaning, as the companies are responsible for proper financial management of those companies, remember the government of India is also equally responsible for the effective and efficient financial management of this country or this country's economy. Through these policies, government conveys as to how it plans to manage country's finance and control the fiscal deficit and administer money supply and tax administration for overall well-being of the nation and its citizen. So that is what is fiscal policy. Fiscal policies are the policies which are used by the government for ensuring proper financial discipline and growth of the economy and well-being and welfare of the citizens of the country. Now, what are the objectives of fiscal policy? So for government of any country, and remember, whatever we are discussing today in the context of the government of India, or we are discussing in the context of the government or Indian economy or Indian finance budget. But remember, the fiscal policy remains the same all over the globe. So the fundamental principles which are applicable in case of a fiscal policy of this country are equally applicable all over the globe in the mutatis mutandis. So what are the fiscal policy objectives? Number one, to maintain and achieve full employment. So please remember, what are the objectives of fiscal policy are also objectives of government of the country. And so when we say objectives of fiscal policy, we can also read it as objectives of the government of the country. So what are the objectives of the government of the country? Number one, to maintain and achieve full employment. So this is the responsibility of the government of the day, to ensure and achieve full employment. Practically, it may not be possible to achieve full employment because there's a dynamic situation, but the government has to make effort through the fiscal policies to achieve full-fledged full employment. Number two is to stabilize the price level, because we cannot, no country can afford to have too much of fluctuations in the price of the products in the country, commodities in the country. So that is the second objective. Third objective of the fiscal policy is to stabilize the growth of the economy. So remember, whose responsibility it is to manage and ensure growth of the economy. It is nothing but the government of the day. That government is responsible for stabilizing and achieving strong growth rate of the economy, and that can also be said, as I said earlier, as the third objective of fiscal policy. Number four is to maintain equilibrium in the balance of payment. So balance of payment का मतलब क्या है? Balance of payment का मतलब ये है what we have to pay to the outside world and what we have to receive from the outside world. There has to be a good equilibrium. And why there has to be good equilibrium? Because if this balance of payment situation is not favorable in the country, then it has got wider implications on the overall economic growth. And therefore, the government of the country also has to work to achieve equilibrium in the balance of payments. That means the government has to, on one hand, ensure that there are imports which are going to help the economy achieve a greater growth rate. And at the same time, it is the responsibility of the government of the day to ensure that there are enough exports so as to ensure that there is not too much of a gap between the imports and the exports. And finally, the fifth objective of the fiscal policy is to promote economic development of the country. Now, for achieving this objective, the fiscal objectives, or for helping the government of the country through the use of the fiscal policy achieve the fiscal objectives, there are four key components of the fiscal policy. And what those four key components are: number one is the taxation policy. So the government of India, by using the taxation, would try and achieve the five objectives of the fiscal policy that we just discussed. Number two, the second component of the fiscal policy is the expenditure policy. So remember, as we all know, the government of our country and the governments of rest of the world also will also use expenditure policy. And why would they need expenditure policy? And how will they use the expenditure policy? And that is, as and when the government needs to spurt the growth in the country, what the governments will do, the governments will increase the capital expenditure. So when they increase the governmental capital expenditure, that gives impetus to the economic growth. And when they, for some reason, theoretically or otherwise, for some reason, if they have to slow down the growth in the economy, then what they would do, they would slow down the capital expenditure. So since they slow down the capital expenditure, there is a less supply of money in the economy. Since there is a less supply of the money in the economy, therefore it results into slowing down of the economy. And that is the second component of the fiscal policy. The third component of fiscal policy is the investment and disinvestment policy. Now, what does it mean? It means investment and disinvestment. So from time to time, and in about last 2 decades, we have seen the governments in power have been consistently following the policy of disinvestment. And that means what? That means whatever investments the governments have had in the PSUs, they have been disposing of, divesting those investment. As a result of that, they are able to generate funds for themselves, which helps them in achieving the fiscal objective. So that is your investment and disinvestment policy. In certain cases, they may also do the investment as well. And finally, the fourth component of the fiscal policy is the deficit and surplus management. Unfortunately or incidentally, as far as Indian economy is concerned, it has been more of a problem of deficit management rather than the problem of surplus management. And that is because since independence, at least in my memory, there is no time when we had a budget where we had a surplus. So from the very beginning, we have had budgets. We have had budgets which were always in deficit. They were never in surplus. Now, friends, at this juncture, I can also tell you, it's not that a surplus budget would mean it is a good sign for sure. No, not necessary. If the economy is fully developed and if they have a surplus budget, that's a good sign. But if the economy is a growing economy or developing economy or economy which is under development, now if that economy has a surplus budget, which of course is extremely unlikely, but in case if they have a surplus budget, it would simply mean that the government is not doing a good job of achieving the fiscal policy objective or fiscal objectives. Now, friends, there are also some tools available, and the tools that are available for the fiscal management relate to the same components of fiscal policy. So the first tool which is available in the hands of the government of the country, that is government expenditure, which is I have just mentioned to you. And the second tool which is available in the hands of the government of the country are the taxes. So meaning what? Meaning if the government needs to spur the growth in the economy, what they would do? They would come out with a lot of tax incentives. And that is where they will try and give encouragement to the industry for making more capital investment. And you can understand if the government, if the corporate sector is making more capital expenditure, that would obviously mean more economic activity. And when it is more economic activity, it would of course mean that there is a good growth in the economy. And likewise, in case for some reason, and unfortunately, there have been umpteen of cases, at least in the first 65 years of post-independence India, where the taxes were used very drastically for slowing down the economy. And not that the economy was doing well, but I suppose it was perhaps lack of far-sightedness that led to situations where the tax rates were as high as 90% in this country. And you can imagine if the tax rates are 90% in any economy, what incentive does it leave for the corporate sector to do more expansion, do more growth in the economy? But the taxes is another tool which is available in with the government for the fiscal management. So invariably, and that is what is happening now, the governments will use taxes by way of incentive, give tax incentive to the corporate sector. As a result of that, corporate sectors makes more capital investment. As a result of that, there are more economic activity, and as a result of that, there is a growth in the GDP. The fourth tool which is available is public debt. Now, what is public debt? Very simple. As the name suggests, public debt का मतलब क्या है? Public debt का मतलब है debt which the government has taken from the public. So that is your public debt. So again, it is a tool with the government for generating funds for themselves as and when they need it. So when the government needs more fund, they would use public debt for raising funds. And when they need less fund, they would release the debt that they may have taken from the public, and that is the public debt. So, for example, the provident fund that we have is an example of public debt, and likewise, small savings that the people do through the post offices is again an example of public debt, because through the provident fund and schemes like that, through the post office savings, the money goes in the hands of the government. So that is how it is a source of funds for the public, for the government, and they can use it depending on their requirements. And the fourth tool is annual finance budget, the one which Mrs. Sitaraman is going to present tomorrow. So friends, these are, and this is the finance budget is another media through which the government will make policy pronouncements, and which is a annual opportunity to the government where they try and tell the nation as to what kind of stand and position they wish to take so as to take the country forward, and so as to ensure that there's a development of the economy, and also there is a development of all the people of the country. So that is your financial budget. That is fourth fiscal tool which is used by the governments for doing the financial management of the economy or fiscal management of the economy. Now, I'm sure this question must be coming in the minds of every one of you as to when the finance ministers make or in the process of putting the finance budget in place with the help, of course, with the Ministry of Finance and other ministries. What are the factors they generally take into account? So let me share with you the factors which would generally be taken into account by the finance ministers during the process of preparation of the budget. So the first and foremost is vision of the leader at the helms of making the country a super economic power. Friends, remember, it's very, very important that the leader of the country has to be really a visionary one, a visionary one. If you have a leader which is lacking the vision, which is a short-sighted person. Remember, such a person with his weak leadership can push the country to the international bankruptcy. And remember, there have been umpteen number of cases all over the globe of this kind. But if you have a strong leader, a visionary and decisive leader, then such a leader can lead the economy of a country towards becoming a super economic power. So such a leader can make a huge impact. And therefore, whenever a finance minister is in the process of preparing the budget, he would or she would always take into account vision of the leader who is at the helms of the nation. Number two, government's vision about the future course for the country. So how the government wishes to take the country forward. And we all know today India's economy is the fifth largest economy. And the vision of this government, as we all read everywhere, is to make the country the third largest economy in the whole world. So obviously, if a country uh, has to be progressed from the fifth point to the third point, uh, third largest economy. Obviously, a lot of positive action plans will need to be put in place. A lot of strategies would need to put in place. So all those strategies and the action plans and the policies and the decisions will need to be incorporated into the finance budget. Number three is the economic survey laid before the parliament prior to the finance budget. As you all know, that today the finance minister presented the economic survey in the parliament. So, and the economic survey is the document which summarizes the overall economic scenario in the whole country as exists today, as it existed in the past, and as it is expected to happen in future. So all these three aspects are also taken into account. So the economic survey is also taken into account in the preparation of the finance budget. Number four, commitments made by the governments in their election manifesto. So I would say not there, in its election manifesto. So obviously the government which has come to power before contesting the elections, they tell the nation as to what their election manifesto is, how they plan to take the country forward, what are the things that they would do in next 5 years. So all those commitments which the government must have made in their election manifestos, those commitments also will need to be incorporated in the finance budget. And next is common minimum program agreed with the alliance partners. So remember, as and when there are governments formed with a lot of alliance powers, in such case, if there are too many parties forming the alliance to form the government, then whatever is discussed and agreed between the alliance partners also has to be part of the finance budget. Next is policy decisions taken by the government in the past. So as we all know, in last 10 years, a lot of things have taken place in this country. A lot of policies have been put in place. A lot of direction has been set in motion. So to put everything in place, say for example, there's a huge network of road building in the country. So how that network is going to be further enhanced. There is a huge network of the airports in this country, how that is going to be put in place. And there are a lot of financial challenges or other challenges. How those challenges are to be met will again be forming part of the finance budget. Memorandums received from the industry and other associations and professional bodies. So I'm sure we all read about it in the newspapers. So the government or the finance minister and their officers will interact with the business associations and the professional bodies to get their feel and feedback as to what their expectations are and how do they think would help the government in taking the country forward. So whatever memorandums or the input or the feedback the government or the finance ministry would gather from these associations and the professional bodies will also be factored into the finance budget. Next is financial and economic needs of the country on various accounts. Prevalent geopolitical conditions. So we all know geopolitical conditions which are prevalent. So we have a neighbor with whom we have a lot of challenges. We have China again. We have strained relations with that country, and unfortunately or incidentally in the past, looks like uh, uh, our policies were more oriented towards China's economy doing well rather than our own economy doing well, and how to reverse that process and how to ensure that we as an economy stand on our own, and rather than depending on outside economies. And then you have war happening between the Ukraine and Russia and also Israel, and so all those factors will also need to be taken into account, and they are of course incorporated in some way or the other into the finance budget, so that the country is prepared to face the challenges that may arise from all these geopolitical situations. Next is other prevalent socio-political economic challenges at the local and global level. So remember, as a country, as a nation, as the government, it is their responsibilities to ensure that everybody is taken care of, everybody's well-being is taken care of. People, the people who aspire to rise high, they are offered opportunities. Everybody in the country is offered opportunities of growth, education, and so on and so forth. So all those factors, all those issues are also factored into the finance budget. And finally, for of course, ultimately, like all other policies, finance budget should be driven by overall and inclusive growth of the economy. So friends, these are the factors which are taken into account by the finance minister and their officers, and his or her officers, or the finance ministry officers, while preparing budget of the country for a particular financial year. Now, what are the broad contents that the government of India finance budget will have? Number one, of course, it will have reference to the economic survey. Number two, it will have policy announcements. Number three, it will talk about the direct taxes changes in the direct taxes provisions, whatever they may be, increase, decrease, or as the case may be, so as to ensure that the aspirations of the people are duly met. There would be mention of the indirect taxes. And because indirect tax, like direct tax, is a major source of finance or funding for the government plans and projects. Pronouncement of new laws from time to time. You would have seen that the budgets are also used by the government for bringing out new laws and welfare schemes for the benefit of the people. It will also have the budget for the current year, the coming financial year, budget estimates for the last financial year, and the budget estimates and the actuals of the previous year. So these are the numbers which are given in the finance budget, so that people know as to what kind of outlays and the resources the government is going to or is planning to generate with the help of the budget. And of course, it will also give you an idea as to if a rupee is coming into the kitty of the government, what is the breakup of this 1 rupee coming into the kitty of the government, and likewise 1 rupee which is being spent by the government, and then the budget will also give a breakup as to where that 1 rupee is going to be spent. So friends, these are the broad contents of the Government of India finance budget. Now let us come to the key terms used in the finance budget. Budget, if you really ask me, is a very simple document otherwise, except for these key terms which are used in the finance budget. And that is because these key terms that are used in the finance budget are not used by all of us or by the common people in their day-to-day operations or day-to-day working or day-to-day business, etc. And that is the reason understanding of budget becomes a small challenge. But I'm sure once we have the understanding of all these key terms about the finance budget, this challenge will disappear from our minds, and we would be able to make sense of the budget every time whenever it is pronounced by the finance ministers not only be able to understand it, but also be able to comment on it as to whether this is a good budget or it is not a good budget, whether it is a progressive budget or it is a regressive budget, whether this budget is truly going to take the country forward or it is going to take the country backward. So all that we would be able to figure it out, I am sure, once we have clarity about all these key terms used in the context of the finance budget. So let us understand as to what these key terms are which are used in the context of finance budget. So number one is revenue versus capital budget. So please remember, the finance budget that would be presented tomorrow by the finance minister will have the revenue budget and it will also have the capital budget. So how do we understand the revenue and capital? So those of you who are from the corporate will understand very easily as to what revenue would mean and what a capital would mean. But a simple definition that I would like to give you so as for enabling you to appreciate and comprehend as to what a revenue budget would mean or what a capital budget would mean. So when an expenditure is going to create an asset, that is referred as capital budget. So when an expenditure is going to create an asset, it is referred as capital budget. When an expenditure is not going to create an asset, it is referred as revenue budget. Meaning what? Meaning revenue expenses are the expenses which are done one time and finished, and they give you benefit only one time. Capital expenditure give you benefit over the years. Over the years, they don't give you benefit only one time, but they give you consistently for many years to come. So that is the principal difference between the revenue versus capital budget. And I'm sure you will not have any difficulty henceforth to understand this. The finance budget would comprise of the revenue budget and capital budgets. Revenue budget does not alter government's assets and liabilities, whereas the capital budget does it, as we discussed already. Capital receipts and capital payments make up the capital budget, while the revenue receipts and revenue expenditure constitute the revenue budget. And we will understand as we move forward different items of capital receipts and capital payments. And likewise, we will also understand different items of revenue receipt and revenue expenditure used in the context of the finance budget of the government of India. Please remember, the budget has to distinguish between receipts, expenditure on revenue account from the other receipts and capital and expenditure on the capital account. And that is what the budget has to do. And how would the budget do it? The budget would do it by segregating the budget between two parts, revenue budget and the capital budget. Please remember all receipts in the Consolidated Fund of India. So what is a Consolidated Fund of India? Now, this is a fund where all the receipts get accounted, and it is from all the receipts which are getting accounted in the Consolidated Fund, the government would be able to use those funds. Please remember, for using the funds available in the Consolidated Fund of India, you would need the approval of the parliament, which of course is done from time to time, generally one time. And then there is another fund which is known as Contingency Fund of India. Now, Contingency Fund of India is another fund from where the government in power can use the funds without waiting for the approval from the parliament. And that is because sometimes in case of a situation where for whatever reason approval of the parliament is not available, then the government can run the administration by using the funds which are kept in the Contingency Fund of India, which, as I understand, currently has a size of 30,000 crore, and for which you only need approval from the president of the country. So friends, this is your revenue versus capital budget. Now, let's understand what are the revenue receipts before we understand what are the revenue expenditure, and also understand the capital receipts and capital expenditure. So the revenue receipts include mostly tax revenues tax revenues, but also non-tax revenues, which consists of interest and dividend on investments made by the government and fees and other receipt for services rendered by the government. So primarily, remember, the revenues receipts of the government will comprise of two component, tax revenue and the non-tax revenue. Tax revenue and the non-tax revenue. What is the meaning of tax revenue? Meaning of tax revenue is very simple. The revenue collected by the government through the direct taxes or the indirect taxes are nothing but your tax revenues. And what are the non-tax revenues? Definition, of course, is very simple. All the other revenues, all the revenue receipts of a government which are not tax revenue are its non-tax revenues. And the examples of non-tax revenues in case of the Government of India finance budget, number one is interest, number two is dividend on the investment that the government must have made from time to time, and it is also fees and the other receipts which are gathered by the government from different entities. For example, government raises revenue from telecom industry. So we all know that the government will charge fees for license fees for from telcos for a spectrum, which is a sovereign asset allocated to them. Now, that is another example of revenue receipt. Now, when we talk in terms of sovereign assets, friends, in simple words, it would mean sovereign will simply mean an independent authority which can simply be referred as government of the country. So when you say sovereign asset, it would also mean you are saying the government assets actually. So that is how it is. All receipts like taxes and expenditure like salaries, subsidies, and interest payments that in general don't entail sale or creation of assets fall under the revenue receipts and expenditure, as I already explained to you little while ago. Now let us understand what are the revenue expenditure. So revenue receipts, of course, would mean the sources of funds coming to the government, and the revenue expenditure would mean the expenses that the government would incur in running the administration of the government. So what are the examples of revenue expenditure? The examples of the revenue expenditure are administrative expenses. I am sure we all understand government in our country is so huge with so many departments, so many ministries, and obviously for running those ministries, running those departments, they have to spend money on salary, administration, interest payment on debt, and giving the subsidies. So these are the examples of revenue expenditure. So when the government is paying salary or pension payments or interest payments on debts or these subsidies, now these are all examples of the revenue expenditure. And I'm sure you can remember all this, all you can understand, all these expenses which are incurred by the government of India, they do not result into creation of any asset, and that is why they are referred as revenue expenditure. A revenue expenditure, and please remember, this is something which is very, very important for all of us to remember and keep in mind. An expenditure that does not result in creation of a capital asset is a revenue expenditure. An expenditure that results in creation of a capital asset is a capital expenditure. Now let's look at the capital receipt. So having understood what is a revenue receipt, now let us understand what is a capital receipt. And I'm sure all of you would remember, very simply speaking, a revenue receipt and capital receipt is very simple. So revenue receipt is something which is used by you for meeting your revenue expenses. And capital receipts are something which would result into either in reduction of a liability, or it would result into increase of an asset. Increase of an asset, that is what is your capital receipt. So capital receipts include market borrowing, other loans, non-debt receipts like proceeds of disinvestment, sale of government assets, and recovery of loans. So these are the examples of capital receipt. So again, remember, capital receipts can be understood in two ways: capital receipts which are debt, and capital receipt which are non-debt. So capital receipt which are debt are nothing but borrowing and the other loans. So the government would take loan from different sources. So those would be debt capital receipt. And then you also have non-debt receipts, non-debt capital receipts. What would this include? This would include proceeds of disinvestment. That means what the government, we all know, in last 2 decades, so much of divestment has taken place by the government, where the investment made by the government in the PSUs have been divested to the public. So the money that is collected by the government through these proceeds of disinvestment, remember, is a non-debt capital receipt. Sale of government assets. So sometimes governments do sell their assets. Uh, and in my view, there is nothing wrong. If an asset is not going to give you benefit any time to come, it is better to dispose that asset off, recover the money, and use that money for some productive work. That would be much better. And also recovery of loans. So please remember, not only the government of the country would take loans from others, but they would also give loans to others. So when the government will give loan to others, it will be it will be debt capital expenditure, capital outgo. When such loans are recovered by the government, so when these loans are repaid by the beneficiaries back to the government, now this is again a non-debt capital receipt, which is recovery of the loans. Now, these receipts cause a decrease in government's capital assets. So, all these loans, all these receipts that you have will cause decrease in the government's capital assets. And I'm sure you can understand how would that happen. So, the government has given a loan to XYZ country or agency or department or states. The loan is given. So, when the loan is given, a capital asset is created. When this loan is paid back by the beneficiary, the capital asset is reduced or it is removed. And that is how all these receipts that we are talking about will cause decrease in government's capital assets. Capital account shows all receipts from liquidating, for example, selling shares in a public sector company, that is disinvestments, assets, and spending to create assets, and lending to receive interest. So that is how the capital account shows all receipts from liquidating. Receipts in the capital account of the consolidated fund. So please remember, the consolidated fund of India that I spoke to you little while ago will have two parts. So it will have the revenue account and it will have the capital account. So when you talk in the context of capital receipts or capital payments, the capital, the consolidated fund of India will have receipts in the capital account that would be grouped under three broad heads. And one is public debt, which means the money that the government has raised from the public. Recovery of loans and advances, that means what the government gave to others in the past. Recovery of that money is again going to be capital receipt recorded in the capital account in the consolidated fund of India. And then, of course, there are other miscellaneous receipts. I'm going to talk about them as we move forward. So this is all about the capital receipts. Then, of course, you got a capital expenditure. So I'm sure we are very clear now the difference between the revenue and the capital. And we are also very clear as to how the revenue and the capital differentiates from each other. So capital receipt is something, a source that is for the government to receive money. And then, of course, government also have outgo on account of the capital expenditure. So these capital expenditure creates government assets or reduces its liabilities. It consists of the capital expenditure consists of acquisition of assets like land and building, machinery and equipment. Also investment in shares and securities of other banks or Reserve Bank of India or other sovereigns. It can be anything. And of course, loans and advances granted by the center to the state and the union. So I'm sure you can understand. So when the central government is giving loan to states or union territories, this outflow is a capital expenditure for the government, and it is resulting into creation of an asset. So the money which the central government has to receive from the states and the union on account of the loans and advances granted to them is creation of an asset for the central government or the government of India. Few examples of revenue receipts, revenue and capital receipts. So the example of revenue receipts, tax receipts, and also spectrum fee from telcos. So these are examples other than what we already have discussed. Examples of capital receipts will include domestic and external borrowing, proceeds of disinvestments or divestments, recovery of loans given by the government. So these are examples of revenue and capital receipts. I'm sure if you have understood the concept of revenue and capital, you would also be able to think of many such examples of revenue receipts and capital receipts for the government of India. Now, let us focus on and let us understand and focus on sources of tax and the non-tax revenue. At the outset, I'm sure we all are very clear. Tax, source of tax, meaning when the revenue is coming to the government from the tax, and non-tax revenue, which means a source of revenue for the government where tax is not involved. That is non-tax revenue. Let us first look at the tax revenue. So tax revenue is collected from taxes imposed on income and profit, direct taxes, and those levied on consumption of goods and services, which is indirect taxes. So the tax revenue, friends, would comprise of the direct tax and the indirect tax. Direct tax would mean collecting the tax directly from the individual or from the corporate, and the indirect tax would mean collecting the tax on the goods and services or the transaction, which is not directly collected from the taxpayer, but it is collected through the intermediaries. So, for example, the GST in this country is collected from the end user. And how it is collected by the government from the end user? It is collected by the government from the end user through all the companies and the entities which are in between the producer of the goods to the end user of the goods. So all those intermediaries which are there, through these intermediaries, the government will collect the GST, Goods and Service Tax Act. So this is the main source. So please remember, tax revenues are the main source of revenue receipt for the government. Tax is an involuntary fees levied on individuals and firms by the government to finance its running of the administration and other activities. It is involuntary fees. So involuntary fees का क्या मतलब है? Involuntary fees का मतलब ये है, given the choice, the payer will never like to pay it, but it is imposed by the government, they have to pay. So they have no choice, they have to pay. So this is an involuntary fees levied on the individuals and the firms by the government. Indirect taxes include the GST, basic customs duty on the imports. While personal income tax levied on the individuals, corporate income tax, and the capital gain tax are the examples of the direct taxes. So these, friends, are the tax revenues for the government. Now let us focus on the non-tax revenues. So what are the non-tax revenue? Any loan given to state government, public institution, PSUs come with a price, that is interest, and forms the most important receipts under this head apart from dividends and the profit received from the PSUs. So that is number one, non-tax revenue. That means revenues other than the taxes, direct or indirect. And that is the interest, that the interest on the loan that the central government would have given to the state governments, public institutions, and PSUs. Other than dividends and the profits received from the PSUs, we all know how the PSUs would pay dividend to the government of India. And recently, I'm sure all of you would remember, Reserve Bank of India also has been in use for last few years for making payment of huge dividend to the government of India, which would never happen in the past. At least it was not there in the public domain. The government also earns various services, including public services like railways. So of this, the railways is a separate department, though all its receipts and expenditures are routed through the consolidated fund. So these are the non-tax revenue. And I'm sure you would remember non-tax revenue would simply mean a source which is not a tax source. We also would remember about the public debt that we discussed little while ago in the context of the Consolidated Fund of India. And the public debt is one of the component of the Consolidated Fund of India, where the receipts of the government would lie under the broad head of public debt. So what public debt is? Public debt in simple words means debt taken by the government from the public. It is total amount borrowed by the government, while a government appointed panel had pitched for debt to GDP ratio of 60%, 40% for the center, 20% for the state by 22-23. The ratio peaked at 89% in FY21 and was at 83.4% in FY22. And I'm sure you can very easily understand this is an extremely dangerous sign. So according to the panel, the maximum the debt to GDP ratio could be 60%. But here we are almost touching 100%. And remember, this is the figure for FY22. So we really do not know as to what this figure would be for FY23 and 24. But obviously, this ratio has to be maintained low at the recommended level of 40%. In budget parlance, the difference between the borrowings, public debt receipts, and repayment, public debt dispersal during the year is known as net accretion of the public debt. इसका मतलब क्या है? इसका मतलब ये है कि the difference between the public debt receipt minus the public debt dispersal gives you an idea as to what has been the incremental public debt for the government in a particular year, or there has been a decrease in the public debt in a particular year. The debt serviced out of the Consolidated Fund of India in the center's case includes a large internal debt component and much smaller external debt component. Now, this public debt, friend, can be split in under two heads. So one is internal debt and two is external debt. And I'm sure you can understand very easily. So what is the meaning of internal debt? It simply would mean the debt taken by the government within the country. And the external debt would mean debt taken by the government from outside the country. So let us understand some of the sources of the internal debt for the government of India. So one is treasury bills and dated securities. So treasury bill would mean the securities with a tenure of less than 1 year, and dated securities will mean 10 securities of longer duration. Longer duration, that means duration of 1 year or more than 1 year. Number two, the internal debt would comprise of the second source for the internal debt for the government of India is ways and means advances. Number three is the issues of securities against small savings. So what the government through the post offices does is it receives small savings and issues different securities. So that is the third source of internal debt. And please remember, this third source of internal debt for all these years have played a very significant role in India's fiscal management. but looks like currently the saving rate in this country is on a decline, and which obviously is a reason or matter of concern not only for the Reserve Bank of India but also for the government of India. And the fourth component of the internal debt is the miscellaneous capital receipts, and that is what we will understand one by one. So let's first understand treasury bills or T-bills or dated securities. So treasury bills, they are popularly known as T-bills and T-bills. So these are bonds, debt securities with maturity of less than 1 year, and those are your treasury bills. So treasury bill may have a maturity of 14 days minimum, or maximum it can have a maturity of 360 days. So not more than that. And those are your treasury bills. And treasury bills, remember, are always issued at a discount to the redemption price. They are always issued at a discount to the redemption price. So the benefit for the subscriber to the debt to the treasury bill is the difference between the subscription price and the redemption price. These are issued to meet short-term mismatches in receipt and expenditure of the government. And when you have the securities, the government securities, Government of India securities, which have a longer maturity than 1 year. Now, these securities, these long-term securities, are also referred as dated securities. So that's number one, as part of the internal debt of the Government of India. Number two is something which is known as ways and means advance. Now, what is ways and means advance? So please remember, Reserve Bank of India acts as banker for the central government as well as for the state government that we all know. So Reserve Bank, RBI is a banker of not only of the banks, but RBI is also banker for both the central and the state governments. In that role, as banker for the central government, RBI provides a breather to manage mismatches in the receipts and payment in the form of ways and means advances. Ways and means advances. So as and when Government of India is having gap in their requirements and availability of funds, then the Reserve Bank of India will bridge this gap through a product which is known as ways and means advances. So ways and means advances in that case is the second component of internal debt for the Government of India. The third is securities against small savings, as we discussed a little while ago. The government meets a small part of its loan requirement by appropriating small savings collection by issuing securities to the fund. Currently, the country is experiencing a decline in the rate of saving, which apparently is a matter of concern for the Reserve Bank of India and so also for the Government of India. And why is that so? Because please remember, the small savings, the saving rate or the saving rate of small savings or the saving rate in this country has been considerably high in comparison to rest of the economies or rest of the world, which apparently has been a very good facilitator of economic activity or capital transformation or capital formation in this country. Now, because of decline in the saving rate in this country, the funds which are available for the capital formation are declining, which are impacting the economic growth of this country. And that is why it is a matter of concern for the Reserve Bank of India and also for the Government of India. And I'm sure they are working to ensure as to how to encourage people to do more savings. And the fourth component of the internal debt for the Government of India is miscellaneous capital receipts. So these are primarily receipts from disinvestment in public sector. So I'm sure friends, अगर आप गूगल करेंगे तो आपको मालूम पड़ेगा कि लास्ट 20 years में गवर्नमेंट ऑफ इंडिया ने बहुत कुछ डिसइन्वेस्टमेंट किया है, बहुत कुछ डिसइन्वेस्टमेंट किया है, which means what? Which means the investment that the Government of India had in the PSUs all those have been disinvested. So say, for example, the Vedanta group has got Hindustan Zinc. Now, Hindustan Zinc is nothing, but Hindustan Zinc once upon a time was a government of India entity. Now it has been divested and it is currently owned by the Vedanta group of Anil Agarwal. Likewise, there used to be a company called VSNL, Videsh Sanchar Nigam Limited. So Videsh VSNL was divested and sold to Tata's, and now it is known as Tata Telecom. So there are many such examples, where the government of India have divested. So wherever the government of India would do any divestment exercise, so the funds that would be received will be part of the miscellaneous capital receipts. Now let us focus, having covered the receipts, capital receipts. Now let us focus on the capital expenditure. So as part of the capital expenditure, the first thing we need to understand is the central plan. The central plan is government's annual expenditure sheet with a 5-year roadmap. This is how the government gets the money for the grand 5-year exercise. The funding of the central plan is split almost evenly between the government support from the budget and internal and extra budgetary resources of the state-owned enterprises. The government support to the central plan is called as budget support. So the government support to the central plan is called as budget support. Plan expenditure. This is essentially the budget support to the central plan. It also comprises the amount the center sets aside for plans of states and union territories. Like all budget heads, this is also split into revenue and capital component. Non-plan expenditure. All those bills that the government has to pay under the revenue expenditure uh, heads are bunched up: interest payments, subsidies, salaries, defense, and pension. Now, all these expenditure that the government incurs, remember, are referred as non-plan expenditure. Now, what is the meaning of plan expenditure and the non-plan expenditure? I think we need to be very clear about it. So, plan expenditure would mean the expenditure which is going to help the government or help the economy in creation of more assets, which ultimately are going to help the economy directly. And the non-plan expenditure are the expenses which do not result into creation of an asset. But it does not mean that the non-plan expenditure do not help the economy. The interest payments, subsidies, salaries, defense, and pension. Now, of course, these expenses are non-plan expenditure. They don't help the economy directly, but of course, because of these expenses, the administration is possible, and that is how, not directly, but indirectly, the non-plan expenditure also help the economy. The capital component in comparison is small. The largest chunk of this goes to defense. Now we come to the very important part of our session today, that is types of deficits and their significance. And friends, this is where we really need to have a good handle and good understanding so as to be able to have a good stronghold on understanding of the finance budget. So when you talk about the deficit, so what is deficit? In simple words, deficit is nothing but difference between the income and expenditure. So difference between the income and expenditure, meaning what? Meaning when there is an excess of expenditure over income. When there is excess of expenditure over income, there is a deficit. And when there is an excess of income over expenditure, then there is a surplus. Incidentally or whatever, unfortunately or incidentally, as I was mentioning earlier, we never had a problem of surplus ever in the history of this country's economic administration where we had a surplus budget. So invariably, we always have had deficits in our budget. And that is what we need to be aware of and we need to remember. Capital government expenditure can be split into capital and revenue expenditure that we have understood. Capital expenditures includes those expenses which result into creation of an asset. So this is what you can always remember. So when an asset is going to result into creation of an asset, that means that is a capital expenditure. If that expenditure is not resulting into creation of an asset, you can understand this is a revenue expenditure. Revenue expenditure is primarily that which does not result into asset creation. And just to reinforce our understanding, interest payments, salaries, subsidies are all examples of revenue expenditure. When government's expenditure exceeds its receipts, there is a deficit. The government has to borrow to meet the shortfall or deficit, and that is why it is a problem. Right? So why deficit is a problem? Deficit is a problem because if there's a gap between your revenue, your receipts, and your expenditure, if there's a gap, and if that gap is negative, then you have a problem, because this gap that you have between the revenue and the expenditure has to be bridged so as to ensure that the economy runs very strongly. It has to be bridged from where? From the borrowing. So when you and that is the problem. And the problem with the borrowing is that when you borrow, not only you have to pay interest on it, but you also have to pay one day back. And that is the reason why deficits are considered to be ills. Now, what are the types of deficits? So primarily or basically or fundamentally or really, there are only three types of deficit that we talk in terms of the finance budget of our country. One is fiscal budget, second is revenue budget, and third is primary budget, primary deficit. So fiscal deficit, revenue deficit, and primary deficit. Let's understand as to what do they mean. So when we say fiscal deficit, what does it mean? When we say revenue deficit, what does it mean? When we say primary deficit, what does it mean? And how do we arrive at these deficit figures? So number one, fiscal deficit का मतलब क्या है? Fiscal deficit, which is also known as FD, fiscal deficit, total receipts minus total expenditure. Meaning what? Meaning revenue receipts plus capital receipts minus revenue expenditure minus capital expenditure. That difference is your fiscal deficit. I'm assuming that your receipts are less and your expenditures are more. And that is why you have a fiscal deficit. So fiscal deficit, please remember, is also known as overall deficit. Overall deficit, because fiscal deficit tells you the total deficit in the budget of the country or in the finance budget of a country. So that's your fiscal budget. So here you would take into account the revenues also, and you would take into account the capital also, capital expenditure also. So you will take both revenue receipts, capital receipts, revenue receipts plus capital receipts, revenue expenditure plus capital expenditure. So difference between these two is your fiscal deficit. Then you have a revenue deficit. How do you calculate revenue deficit? So here you will take only revenue receipts into account and only revenue expenditures into account. Unlike fiscal deficit, where you take the capital receipts also into account, capital expenditures also into account. But when you are trying to arrive at the revenue receipt, that's where you will take only the revenue receipt into account and the revenue expenditure into account. So when your revenue receipts, when your revenue receipts are less than your revenue expenditure. So when your revenue receipts are less than your revenue expenditure, that means you have a revenue deficit. But if your revenue receipts are more than your revenue expenditure, that means you have a revenue surplus. Remember, in case if a country has a revenue surplus, that definitely is a good sign. Fiscal surplus is not a good sign. So overall fiscal surplus. So instead of having a fiscal deficit, if you have a fiscal surplus, that is not a good sign. But if you have a revenue surplus instead of revenue deficit, that for sure is a good sign. And why it's a good sign? Because it means that the country's economy is able to meet its revenue expenses through its revenue. And that means it does not have to depend on the capital receipt for managing its revenue expenditure. And that is what you must remember and understand. The third is primary deficit. Now, what is primary deficit? Primary deficit would mean fiscal deficit minus. So this is the fiscal deficit, overall deficit, or total deficit. So fiscal deficit, you can call it as overall deficit. You can call it as total deficit. They all would mean the same thing. So when you take the fiscal deficit of the country, and from this you minus interest payment to the government, interest payments the government makes on its earlier borrowing, and that is your fiscal, that is your primary deficit. So primary deficit का मतलब क्या है? प्राइमरी डेफिसिट का मतलब है कि आपकी जो टोटल डेफिसिट है उसमें से आप क्या माइनस करिए, आप उसमें से माइनस करिए इंटरेस्ट दैट द गवर्नमेंट वुड नीड टू पे ऑन द पास्ट बोरोइंग्स, right? So when you minus interest that the government would pay on the past borrowings from the total deficit, what you get is your primary deficit. And this primary deficit, remember, is of a very, very high significance. And why is that so? Because primary deficit is an indicator. Is an indicator of what? It's an indicator कि अगर एक कंट्री की प्राइमरी डेफिसिट यानी कि उसकी जो फिजिकल डेफिसिट है और वो उसकी जो रेवेन्यू interest that the government has to pay on the past borrowings, अगर वो shrink हो रहे हैं, अगर वो shrink हो रहे हैं, और इसका मतलब the primary deficit is increasing, that is a bad sign. That is a bad sign. And why that is a bad sign? Because अगर आपकी primary deficit बढ़ रही है, इसका मतलब ये है कि आपके you are not able to manage your revenue receipts and your capital receipts, your revenue expenditure and capital expenditure. So primary deficit, if it is decreasing, that's a good sign. And remember, in any case, interest payment that the government has to make on the past borrowing is not a good sign for sure. But remember, it is at least not the expense for, it is not really an expense arising on account of the current year's operations. It is on account of the past borrowings. So to that extent, it can be forgiven, even if this figure is large. So fundamentally, and as a fiscal management, as a good financial management, all the global players are always looking at the primary deficit of a country. So if the primary deficit of a country is shrinking, that is considered to be a good sign. If the primary deficit is increasing, that is considered to be a bad sign as far as the fiscal management of the economy is concerned. Also remember, all these deficits that we are talking about, remember, are expressed as a fraction of nominal GDP for better appreciation, comprehension and understanding. So आपने देखा होगा कि जब भी when the finance minister would present the budget, she would of course give the absolute figures of the fiscal deficit, revenue deficit and primary deficit, but she would also express the fiscal deficit, revenue deficit and primary deficit in terms of percentage to the overall budget or overall budget of the country, and because then it becomes comparable. You cannot compare, you cannot make sense out of the absolute numbers, but when they are converted in as an expression in terms of percentage, then you are able to compare one year's fiscal deficit percentage with the previous year's fiscal deficit percentage, or with the budgeted fiscal deficit of the last year, or the budgeted revenue deficit of the last year, or budgeted primary deficit of the last year. Fiscal deficit, it is usually referred as fiscal deficit, that is overall deficit or total deficit. The government's non-borrowed receipt, non-borrowed. Please remember, government receipts can be classified into two categories: borrowed receipts and non-borrowed receipts. Earlier we discussed, we said non-debt receipts or debt receipts. So borrowed receipt or debt receipt would mean the same thing, and that means the monies that the government is raising by borrowing is the borrowed receipt, and the money other than the borrowed receipt that the government is raising is referred as non-borrowed receipts. So the government's non-borrowed receipts, that is revenue receipts plus loan repayments received by the government plus miscellaneous capital receipts, primarily disinvestment proceeds, all fall short of its expenditure, and that is where you have a fiscal deficit happening. So basically, fiscal deficit is the difference between total receipts minus total expenditure. It can also be said as the excess of total expenditure over total non-borrowed receipt is fiscal deficit. Now, this gap is bridged by borrowings, and that is why total borrowings used to bridge the receipt and expenditure gap is also referred as fiscal deficit. So, fiscal deficit का एक मतलब ये भी है, fiscal deficit is equal to the borrowed funds, and I'm sure you will understand it very easily. Fiscal deficit would mean borrowed funds. Fiscal deficit would mean borrowed funds. So, the size of the fiscal deficit and the borrowing of a country would always be the same. And so remember, higher the amount of fiscal deficit, higher the borrowing. And please understand, higher the borrowing, higher interest service obligation, higher repayment obligation, and which of course are not good for the economy. In simple words, the government needs to arrange so much of funds through borrowing, and borrowings entail interest burden, which causes further damage to the economy unless the borrowings are used to generate more revenue than the interest being paid on the same. So remember, borrowing per se is not bad. There's nothing wrong with the borrowing per se, so long as the revenue that you're going to generate from the assets that you would create from the borrowed capital are more than the amount of interest that you would pay on the borrowed capital, it is a good sign. Challenge is when the revenue that you are generating from the assets that you are creating from the borrowed funds is less than the interest that you are paying. That is suicidal. Or you are using the borrowed funds for the consumption, for meeting your revenue expenditure. That again is suicidal for any economy. So the fiscal deficit is measured as a percentage of GDP, as it may not be appropriate to compare borrowings of different years in absolute terms. Even if you want to compare, you will not be able to make any sense out of them. This is where the government feels the pinch. It often lives beyond its means, a lot like situation where mortals find themselves in. So जिस तरह से एक आम आदमी कई बार करता है, खर्चा आमदनी 98, खर्चा रुपया. So your income is rupee 1 and your income is 50 paisa and your expenses are ₹1. So you can understand this person is going to be in trouble, of course. And same is the case with the fiscal deficit also. If this fiscal deficit is sizably high, and that is not a good sign for any economy. It also results into the degrading of the credit rating of the country. So remember, credit rating of a country is also linked with the fiscal deficit and overall fiscal management of the economy. So lesser the fiscal deficit, better would be considered the credit rating of the country, because lesser the debt, lesser the financial risk. Lesser the financial risk, better is the credit rating. Non-borrowed receipts are used to bridge the fiscal deficit, and that is what is the challenge. What is the significance of fiscal deficit for the GDP of a nation? So हमने डिस्कस किया इसके बारे में ऑलरेडी, पर थोड़ा सा और चर्चा करेंगे. Fiscal deficit and the GDP. Fiscal deficit is an indicator of additional debt the country is adding. So मान के चलिए, सिंपल सी बात है, जितना fiscal deficit है उतना additional debt the country is going to take. So lesser the fiscal deficit, lesser is going to be the incremental debt. Higher the fiscal deficit, higher is going to be the incremental debt. And debt, I'm sure you all understand very well. Lesser the debt, better it is. Higher debt is fine so long as you are able to generate more return than the cost of the debt that you are raising. In absolute terms, the fiscal deficit may be large, but if it is small, compared to the size of the economy, then it is not such a bad thing. So it is possible that in totality, you look at the size of the fiscal deficit, it's very high. But when you look at it as a percentage of the size of the economy, it may be very small. And if it is a small, then it is not a bad sign, even though the size of the fiscal deficit is large. And that is because size of the economy also equally large. Prudent fiscal management requires that government does not borrow to consume in the normal course. And that is what I was telling you earlier also. So long as you are borrowing for creating assets, revenue generating assets, which is going to give a return higher than the cost of the debt that you are borrowing, it is perfectly fine. It is perfectly fine, not otherwise. Whenever and wherever any government is giving any freebies, and this is where all of you who are listening to this presentation, you must make a mental note, because that is where you and I have a responsibility as professional. Whenever and wherever any government is giving freebies, which is not adding any value to the GDP, those freebies are at the cost of future of coming generation. Please, we should be aware of this danger and vehemently oppose all such government and politicians. So this is the responsibility of every citizen in this country. Any politician, any government which is resorting to freebies only with an objective to come to the power, this must be vehemently opposed by everyone in this country. And why? Because such politicians are endangering the future of coming generation. And that is because any government, any politician who is resorting to freebies, and I'm sure you can understand, it obviously is going to increase the fiscal deficit gap. जितना आप पैसा मुफ्त में बांटोगे, उतना आपका ज्यादा कंजम्पशन बढ़ेगा. जितना आपका ज्यादा कंजम्पशन बढ़ेगा, उतनी ज्यादा आपकी फिस्कल डेफिसिट बढ़ेगी. जितना ज्यादा आपकी फिस्कल डेफिसिट बढ़ेगी, उतना ज्यादा आपको ज्यादा पैसा उधार लेना पड़ेगा. जितना ज्यादा पैसा उधार लेंगे, उतना आपको इंटरेस्ट देना पड़ेगा और उसको रीपे करना पड़ेगा. उतनी ज्यादा आपकी जो इकोनॉमी है प्रॉब्लम में आएगी. उसकी वजह से आप तो तकलीफ में रहेंगे, यू विल face difficulty, but the coming generations of this nation will also face huge difficulty. And that is what is the responsibility of every one of us, to ensure that such politicians, such governments are vehemently opposed, and there's a hue and cry against such politicians who are hell-bent to create problem for economy of this country. Let us now understand what is revenue deficit. Revenue deficit is very simple, as we have discussed earlier also. Revenue deficit would mean excess of revenue expenditure over revenue receipt. So fiscal deficit में आप क्या करते हैं? In fiscal deficit, you take into account the revenue receipts and the capital receipts, revenue expenditure, and also the capital expenditure. But when you are looking at the revenue deficit, you only look at the revenue receipts and the revenue expenditure. The gap between the revenue expenditure and revenue receipt is your revenue deficit or revenue surplus. Excess of receipt is surplus and excess of expenditure is deficit. It is not just because it's a deficit, but that it is a revenue deficit, which makes it an important control indicator. It's not just because it is a deficit, but it's a revenue deficit, which makes it an important control indicator. So it's not that it's just a number, because a revenue deficit is an indicator कि आपकी आमदनी 98 है और खर्चा आपका रुपया है. So as a nation, you can imagine, as if our consumption is more than the revenue that we generate, you can imagine we are going to be in trouble. So any individual, if his income is 50 paisa and his revenue is his income is 50 paisa, his expenditure are 1 rupee, obviously this gentleman is going to be in trouble. And same is applicable to a nation's economy also. And that is what is your revenue deficit. Revenue deficit, as I said, means the government is unable to meet its running government is unable to meet its running expenses from recurring sources of revenue, which is not a good sign for the economy as a whole. All expenditure on revenue account should ideally be met from receipts on revenue account. The revenue deficit should be zero, else the government will be in debt. Understandable. You can't borrow. Remember, you can't borrow to eat food every day. Someday you need to start earning enough to meet your expenses by yourself. Else you are in a big trouble and you are going to be in a debt trap. And this is equally applicable to the government as well. And therefore, when you are looking at the budget tomorrow, also look at the revenue deficit figure and see as to how it is progressing over the years. If it is shrinking over the years, it's a good sign. If it is increasing over the years, obviously it is a bad sign. What is wrong with the revenue deficit, high or low? Remember, continued revenue deficit coupled with deficit on capital account is sure sign of impending bankruptcy for the nation as a whole. In other words, continued fiscal deficit over the years is a sure indicator that this country's economy is in trouble and heading for the bankruptcy. And remember, it's not theory, it is all practical. We all have heard of so many examples of financial bankruptcy as a result of the continued fiscal deficit over the years. We have heard of Venezuela, we have heard of Argentina, we have heard of many of the countries. Unfortunately or incidentally, in the year 1991, even our Indian economy was also at the threshold of international bankruptcy, primarily on account of continued revenue deficit, continued capital deficit, which means continued fiscal deficit. How to put control on revenue deficit? So revenue deficit को कैसे control किया जाए? Number one, by raising revenue. So what the government has to do, the government has to do everything possible under the sun so as to ensure that its revenues are increasing. Its revenues are increasing, whether by way of dividend, whether by way of interest, whether by way of taxes, indirect tax, direct tax, whatever it may be. So the government has to ensure that there is an increase in the revenues year after year. Number two, the government needs to put a check on subsidies and other related expenses and also interest payments. Of course, for the interest payments, the government will have to repay the debt. And for repaying the debt, the government will have to have the money. So if the government does not have the money, government will not be able to pay the debt. If the government does not pay the debt, obviously they will not be able to reduce the interest payment. But of course, they can definitely do a lot on this front, and that is what the governments do focus on. Number three, and which is very, very important for putting a control on the revenue deficit, and that is control on disproportionate population growth. Please remember, one of the main ills of Indian economy is a disproportionate increase in the population. Disproportionate increase in the population, and you can understand, unproductive population will increase the consumption. Increase in the consumption will increase the revenue deficit. Increase in the revenue deficit will increase the fiscal deficit. Increase in the fiscal deficit will increase the debt and the borrowing by the government. Increase in the debt or the borrowing by the government will result into increase in the interest cost of the government. And you can understand how we are going to get into a vicious cycle. So there's a strong need to focus by the government on disproportionate population growth. The government has to do something very, very urgently to ensure that the growth of population is in alignment with the resources which are available in this country. Otherwise, you can imagine this situation going forward is going to be extremely frightening. If the resources are going to be limited, consumers are going to be unlimited. So obviously there is going to be fight for those resources, and you can imagine what would happen. And therefore, this is one area where the government has to very, very strongly, very, very urgently has to focus. And remember, it is not only the government that has to focus, it is every individual in this country has to understand this frightening situation ahead of us, and do something about it. And that, of course, will definitely improve the revenue deficit situation. And fourth and finally, of course, for controlling the revenue deficit is by vehemently opposing the politicians who aim to come to power based on freebies. तो ऐसे जो भी politicians हैं जिनका की मकसद सरकार में आना है by giving freebies to the population, people, by offering freebies to people, all such the politicians should be banned. Actually, I think the Supreme Court of this country must take this into cognizance, because they are the only ones who can take such a frightening situation into account, because all these freebies are going to be a huge curse for the entire economy and for the entire country. And that is where, in my view, Supreme Court should take cognizance of all these freebies which are distributed by a few which are promised by a few unscrupulous politicians, with the sole objective is to gain the vote of the people and come to power. So these four things, if done in the right earnestness, I'm sure will ensure that our revenue deficit is under control. The third deficit, and that is primary deficit, of course, we have discussed about it a little bit already. Let's just refresh. So primary deficit is the basic deficit figure. It is the basic deficit figure. Usually it is referred as primary deficit. The primary deficit is gross fiscal deficit, or the total fiscal deficit, or overall fiscal deficit that we have understood, as we understood earlier, less interest payment the government makes on its earlier borrowings. So that is what is your primary deficit. So primary deficit will mean fiscal deficit minus interest that the government has to pay on the past borrowings, and that is your primary deficit. Please remember, as we discussed earlier, जितना आपकी primary deficit shrink होगी, it is so much a good indicator of country's economy. If the primary deficit is increasing, that of course is a bad sign for the economy. Primary deficit shrinking is a good sign for the economy. The primary deficit shows the real deficit, which is on account of operational receipts and expenses, revenue, as well as capital. This is one primary indicator everybody likes to watch, as I mentioned a little while ago. When it shrinks, it indicates we are not doing too badly on fiscal path. So जब आपका primary deficit shrink होगा, इसका मतलब ये है कि on the fiscal path we are doing well. और अगर आपकी primary deficit shrink हो रही है year after year, that means country is doing well on the operational front. Why do all global players look at the primary deficit of a country so closely? Lower primary deficit indicates that the economy is doing well operationally, but suffering on account of old sins, that is the past borrowings. So when the primary deficit is shrinking, it gives an idea to the global players that the economy is doing good in the management of revenue deficit, is doing good in management of the capital deficit, and as a result of that, it is doing good in managing the fiscal deficit. And since it is doing good management of revenue deficit and the capital deficit, that means operationally the economy is doing well, and that is what gives confidence to the global players. And that is how you would see that as and when that happens, the credit rating of the countries are increased by global credit rating agencies like Moody's and things like that. Budget estimates. So this is another term that you would come across tomorrow when you would go through the finance budget. Estimates made at the time of presentation of the budget regarding the allocation of funds for different tasks, revenues, and inflows. They are known as budget estimates. These broadly indicate the upper limits of expenditure, expected revenue under various heads. So that is what it is. So when the budget is approved by the parliament, so first the budget is presented, then there is a discussion on the budget, and then there is finally the budgets are approved. When the budgets are approved, that means so much of money the government is approved to spend from the consolidated fund of India. Then you have revised estimates. So what are the revised estimates? So when tomorrow you would see when the finance minister would present the finance budget, she would not only give the budgeted estimates for the year 24-25, she would also give the revised estimates for the year 23-24. So the budgeted estimates of 23-24 would have undergone a change, and now those numbers are presented by the finance minister as the revised estimates for the approval of the parliament. Financial inclusion, of course, we all know this. Subvention, this is how a government bears the loss that the financial institutions incur when asked to give farmers below the market rate. So sometimes as an incentive or as a fiscal measure, the government will give concession to the farmers in interest, and the banks are asked to give loan to the banks to the farmers at a lower rate of interest, but the banks cannot afford to suffer that loss, so the government gives that money back to the government, and that is your subvention. Finally, friends, let us now come to the last part of our session today, and that is fundamental principles of good budget management. So how to ensure, or what are the steps that needs to be taken for ensuring that there is a good budget management in the country? So first and foremost, all expenditure on revenue account preferably should be met from receipts on revenue account only, right? This is number one. Number two, ideally there should be a surplus on account of revenue receipts such that part of capital expenditure are financed through non-borrowed funds. So जितना आपका revenue budget में surplus होगा, उतने आपकी borrowing automatically कम हो जाएंगी, because so much of funds are available for taking care of your capital deficit. At the minimum, the revenue deficit should be zero, else the government will be in debt, and that too for consumption, which is extremely dangerous. Prudent fiscal management requires that government does not borrow to consume in the normal course. Capital expenditure must be productive in nature and not merely repayment of earlier borrowings. Such productive capital expenditures can be more than capital receipts, and the excess ideally financed through surplus of revenue receipts at worst with the borrowed funds. Last but not the least, every citizen has to contribute for the growth of economy and the nation, and there has to be a mega drive about it. And that is where, friends, you and I have a responsibility to ensure that there is an awareness in the minds of every individual in this country to become aware that running the economy may be the job of the government, but contributing to the economy is the job of every citizen of the country. So friends, with this, I come to the close of this session. I'm sure some of you may like to know something about me. So just a small introduction. I am a practicing chartered accountant, valuation professional, independent director on a NSE and BSE listed company, insolvency professional, chartered accountant, social auditor, and also registered valuer for income tax. I have authored 2 books, Finance for Value Creation and You Are a Born Winner. I'm also a global business coach and inspirational speaker. I have delivered my training programs in more than 50 locations all over the globe on a wide range of topics covering finance, risk, Indian accounting standards, IFRS, SOX, Parta system, Companies Act, good corporate governance, SEBI regulations, so on and so forth. I have also delivered programs on the life management, uh, train the trainers in finance, public speaking and communication skills, awaken the winner in you. You are a born winner. How to enjoy life beyond work, how to excel in every walk of life, so on and so forth. Have delivered all these programs in more than 50 locations across 5 continents in Americas, Russia, Asia, Africa, Europe, the Middle East, and everywhere. More than 50 locations. These are some of the locations where I have delivered the programs, like this is Poland, this is also Poland, this is Luxembourg, this is Ukraine, this is Canada, this is Costa Rica, this is also Costa Rica. This is a place, where Swami Vivekanand had delivered his addressed the World Religious Forum more than 130 years back in Chicago. I have had the good fortune of being on this stage from where Swami Vivekanand had addressed the World Economic Forum. This is the session that I delivered in Brazil. I was for a good long period of 6 years with ArcelorMittal, and for them I delivered program all over their locations all over the globe. So this is in Brazil, this is in Belgium, this is in France, this is also in France, this is also in France, and this of course is in Russia. I have many signature certificate programs. So this one is on business valuation, where I would cover every aspect of business valuation, be it Income Tax Act, be it SEBI, be it FEMA, be it RBI, be it derivatives, be it ESOPs, all aspects of valuation. So that's again a signature certificate program that I conduct. I also conduct a signature certificate program on Indian accounting standards and also international financial reporting standards, covering 39 different indices. I've delivered these programs all over the globe. I'm a marathon runner, have run more than 50 marathons in different parts of the country and also different parts of the globe. Also a cyclist and have cyclists again all over the world. Have authored these two books. So this is You Are a Born Winner, and this is Finance for Value Creation. Both these books, incidentally, are available on Amazon and also on Flipkart and also on Notion Praise. So in case if you would like to order these books, you can go to Flipkart or Amazon or Notion Praise, and you would be able to order it online and get it from there. Both these books, friends, are truly amazing. Finance for Value Creation is a book which is written in very simple words. And anyone who is interested in understanding finance, who does not have any background of finance, also will find this book extremely useful. Even the people who are from the finance domain, when they read this book, they come and tell me that this book is truly amazing, and that is Finance for Value Creation. The second book, You Are a Born Winner, again, friends, is a fantastic book. It covers all aspects of your life. So all of us are, remember, born winner. That's a fact. Only thing is we need to become aware. And this book empowers you, equips you to make best of your life and live a life which is meaningful, useful, and purposeful for everyone. So these are the two books that I have authored. I have my own YouTube channel, and on my YouTube channel, from time to time, I have uploaded 2,200 videos on various aspects covering finance, accounts, Companies Act, strategic management, Ind AS, insolvency, business valuation, India's economy, independent director, corporate governance, leadership, and work-life balance. So in case you would like to take benefit of all these 2,200 videos, do subscribe to my YouTube channel. And If you subscribe to my YouTube channel, search it by the name CA Pramod Jain, and I would be very happy to have you on as the subscriber to my YouTube channel, and I'm sure you will find this channel extremely useful in enhancing your knowledge about finance, various aspects of finance. I'm also very active on LinkedIn, and on LinkedIn, now I have more than 25,000 followers, more than 25,000 followers. So, and I keep on uploading many useful videos, contents, information on my LinkedIn page from time to time. So, in case you want to take benefit of those as well, you are welcome to send me an invite for linking with you on LinkedIn as well. So, friends, with this, I come to the close of my session. Thank you so much. It's such a pleasure to be here with all of you and deliver this session for all of you. Please remember, opportunities always come with responsibilities. Let us collaborate and make the difference. Thank you so much. Wishing you a wonderful time. Do watch the budget presentation tomorrow, and I'm sure you will find now the budget presentation even more interesting and engrossing than what it would have been otherwise.